Hello, investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. This is a one-year daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA, and I've left my lines on the chart from last week's report so you could see how accurate the charts were in all markets that were analyzed last week. Now keep in mind we had 100% accuracy in the charts right across the board. And here is the evidence. This is the line that I drew last week, saying that we would reach a target support level right there around 174.42. We hit that level on Thursday, August 6th, and today we have a hammer pattern on the diamond. So what I'm going to do now is remove all my lines drawn so I could draw new lines for you. And I was looking at this midday today, and there was a big red candle, but by the end of the day we closed on a hammer pattern with higher volume. Now as I back up, I have to show you what this really means. This is a gap that was formed back on February 3rd, and the gap has now filled. And if you've been following along with the market guys, especially with gap trading strategies, the rule is 80% of gaps fill, and then once they fill, there's an 80% chance that the market or price will reverse from that point. So now we're looking at a possible bounce for the Dow next week, and I'm just going to be really conservative and look for that bounce right there before any new selling takes a hold of the market. So this is a fairly conservative bounce that I'm forecasting because there's still a gap above the market up here. I'm going to mark that as the resistance point and then move on to the S&P. The spiders, ticker symbol SPY, is also a great representation of 500 stocks that basically move markets globally. And I see once again another accurate reading where this was my forecast from last week. I thought we would go lower. We did. Now there's a hammer pattern forming on the spiders as well. So I'm going to remove those lines, redraw this so that you have a reference for next week. I think we'll see at least a little bounce on the spiders right there. Going to a more broad-based index, which is the Russell 2000, my forecast was that we would pull back from the existing or former trend line. We did just that. We pulled right back. And now again we have a hammer pattern right there. I'm going to leave this trend line in place here, but I'm going to remove the short-term leg there so that we can draw the new move that I think will happen next week. I think we'll once again make a move to try to retest that former trend line and then maybe pull back from there. It's too soon to tell whether or not we will get that pullback. We'll have to do another read next Friday and report back to you then. Looking at the Qs, this is the Nasdaq market, also known as the power shares. Forecasted line still in place right there, came back down, didn't come all the way down to fill the gap, but it did follow my trend line quite nicely. So I'm going to remove that, and this is what I think could happen with the Qs. I think it'll hit resistance and then start to pull back from there, ultimately filling this gap right here. So we're going to remove that support, and we'll wait for this bounce to occur before we draw another support level. You know, keep in mind, technical analysis is a really great tool if you just learn how to keep things simple. Notice my charts do not have stochastics and moving averages and relative strength and Bollinger Bands and all that. Although I could teach you anything you want to know about those oscillators and indicators, I find the most accurate readings come when you're just analyzing price and volume using simple candle charts that have been used for hundreds of years now. They wouldn't be as popular as they are for hundreds of years if they weren't great tools to use. So KISS, keep it super simple in your analysis and go from there. Finally, the VIX. Last week I started analyzing the markets with the VIX, and I thought that this spinning top was enough to signal a possible pivot point because it was so close to support. And what happened, the VIX rallied up following this line very nicely. And right now I'm going to remove this line because I think that this long shadow above this candle right here could suggest a possible pullback in the VIX. Now remember, the VIX, the volatility index here, is a contrarian indicator to the S&P. So if the VIX is looking slightly bearish for the short term, then that means the S&P is going to be more bullish for the short term. So if you have any questions, submit those to me via Twitter, Facebook. You can go to the Market Guys. We're building our following. We're educating people across the globe to be more efficient with their technical analysis. And of course, this will also build your confidence level. I've always believed that if your confidence level is high, your profits will reflect that. Let's face it, scared money doesn't make any money in these markets. Build your confidence by learning how to read simple signals, and you'll be better off for it. This is AJ Monty with the Market Guys signing off. We'll talk to you soon. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our trade alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.